think that company is likely going to come out with some kind of positive earnings for the third quarter?
Correct. We are positive on FMCG's earnings going forward. 2016 was quite underwhelming for a number of them. Number one, revenue wasn't going as high as it were before due to the economic challenges, and then profit margins were hampered by the FX liquidity challenges that the economy faced. So due to FX scarcity, most had to rely on the parallel market to source for FX in order to import some of their raw materials. So that led to the weakness we saw in their gross margins as well as their profit margins. But for 2017 and going forward, because we have seen FX liquidity improve in the economy, Central Bank is now conducting lots of interventions in the foreign exchange markets to provide FX to companies operating in the FMCG space as well as the industrial goods space. So that should probably help them to bolster their margins. So we're positive on their earnings going forward.
All right, talking about third quarter earnings, Forte Oil seemed to be one of the major companies that have come out first with their earnings, and it's quite impressive, posting 5.07 billion profit after tax. Now, was that the kind of result you were actually expecting from Forte?
We probably expected better because if you look at the results as of Q3 standalone, looking at the quarterly results alone, not for 9 months, you will see that there was a weakness in both their revenue and their profit before tax. Revenue was down by about 4.5% quarter on quarter. PBT was down by more than 20%. However, if you look at the performance year to date, that is for the cumulative 9 months period, you will see that they have recorded quite a decent performance. Revenue is down 20% year to date for 9 months period, which we attribute to weaker sales from their fuel segments. However, that was moderated, or that was offset a bit by higher revenue from their power generation business, because last year, due to the attacks by militants on all installations, so they weren't able to get enough gas to power their Gego power plants. However, in 2017, we have seen tension ease in Niger Delta area, and power generation has improved quite significantly, and so that's been driving their sales from the power generation business. But still, due to the weaker sales from the fuel segment, revenue was down by 20%. However, they were able to report what I would call a decent performance for their bottom line. PBT is down about 0.8% compared to the revenue decline of 20%, for 9 months period, and that's because we saw gross margin expansion. The gross margin improved quite significantly, which we attribute to better outputs from their power generation business. They were also able to reduce their operating expenses as well. It is down by about 16.5% year on year. However, there's still a pressure point coming from their finance charges. If you remember, in January they came out with a debt issuance. They issued, I think, a 5-year bond. So now they are paying interest on that bond, and that's a pressure point on their financial performance as well. So decent performance, but we expected better.
Right. Now, that result was posted on Friday, and looking at the oil and gas stocks, Forte Oil dropped on Friday. What could have informed investor sentiment, that bearish sentiment towards that stock on that day they posted that result?
Because the result was a bit underwhelming. It was underwhelming.
What they were expecting, right? Right. Now, so how do you see this particular result driving that stock and perhaps the entire oil and gas sector in the new week?
Well, I guess the result gives us a clue as to what to expect from other downstream majors, because Q3 standalone, margins wasn't so good for few segments, so investors will probably be a bit skeptical when taking positions in other downstream oil and gas companies. For Forte Oil, we do not have a buy rating on the stock at the moment. No doubt the stock price has declined quite a lot since the start of the year. From over 100 naira, it is now down to less than 50 naira. Maybe for some long-term investors, it might be a stock, it might be a viable investment. But for short-term investors, we still think that the prospects of of significant capital gain is still low because of the economic climate. The company's main business is fuel sales as well as power generation, and these two sectors are being challenged. For fuel major, they still have to rely on NNPC supply for them to retail because of the because they could not get FX at competitive rates compared to the NNPC. And then for the power generation business, due to the liquidity crisis we are having, particularly with the discos not properly, remunerating all their invoices to the value chain. So liquidity has been quite poor in that sector.
All right, Omotola, just before I let you go, talking about your recommendation now, what investment recommendation do you have for this week? You don't have a buy rating for FO, so what is your investment recommendation for this week at the equities market? Buy, sell, keep on hold?
Well, for us, we are still buying banking stocks, particularly Tier 1 banks. We like UBA. We also like GT Bank. We also like Zenith Bank. We think their trading multiples at current level is quite attractive compared to where they were at pre-crisis period. UBA is particularly our topic for the week. It's trading at a price to book of about 0.7 times, and for a stock with very high ROE of double digits, nearly 20%, we think there is a prospect for capital gain.
All right, thank you very much for your time,
Omotola
Abimbola. Well, Omotola Abimbola is one of the investment analysts with Afri Invest.